Now let's discuss the accounting for partnerships. The partnership agreement has to specify certain relationships among the partners, obviously names and how much each of the partners contributes in capital, as well as the rights and duties of the partners, the basis for how net income or net loss will be shared amongst the partners, provisions for how assets can be withdrawn, any procedures for submitting disputes during an arbitration, procedures for the withdrawal or addition of a new partner, and the rights and duties of surviving partners in the event of a partner's death. In a partnership formation, assume that these two partners, Rolf and Shay, combine their proprietorships to start a partnership named US Software. These two individuals have the following assets prior to the formation of the partnership. Here we are seeing the assets, cash equipment, along with the equipment's accumulated depreciation that Rolf is combining with Shay's cash, accounts receivable, along with the allowance for doubtful accounts. Here is the fair value of all of the assets. We will record journal entries to record the fair value of the assets at the time the partnership is formed. Rolf will be recording cash and equipment into the company's general ledger and into their books, and Shay will be contributing cash and accounts receivable. We are going to record these at the fair value. Cash and equipment are being contributed by Rolf, so we're going to record those into the partnership's accounting records. And we will credit Rolf's capital $12,000 for the owner investment. For Shay, we are going to be recording cash and accounts receivable into the general ledger of the partnership, along with the allowance for doubtful accounts. And the net of those is the $12,000 increase for owner investments by Shay. As net income is earned and we need to record it into the partnerships, the partners' capital accounts at the end of the period, we need to have a way to divide up the net income or net loss of the partnership. And that's why the partnership agreement must stipulate how the income is divided. Typically, the different types of ratios that are often seen are a fixed ratio, such as income is divided equally, or ratios based on capital balances. So the greater the owner investment, the greater the capital balance, the greater the portion of the income they will be receiving. Or there could be some salaries that different partners are supposed to get, or it could be based on a percentage of interest on the owner's capital balances. So it could be a combination of all of these, salaries, interests, and any remainder going on a fixed ratio. For example, if King and Lee are co-partners, the partnership agreement provides the following on income allocation. Each of these are supposed to get a salary, $8,400 to King, $6,000 to Lee each year. They are also supposed to get interest of 10% on their capital balances at the beginning of the year. Any remaining income is to be divided equally. Capital balances for King were $28,000 and Lee $24,000 as of the beginning of the year. During the year, the partnership earned income of $22,000. The division of net income will be as follows, and we're going to prepare a schedule. First, we allocate the salaries, then we allocate the capital balances, and any remainder of the net income will be distributed equally. So here is our net income of $22,000. First, King gets a salary, Lee gets salary. Total of $14,400 salaries will be allocated. Then 10% of their beginning of the year capital balances. King's balance at the beginning of the year was $28,000. Lee's was $24,000. 10% of that will be allocated. The total interest that we are going to be allocating is $2,800 plus $2,400 or $5,200. Salaries of $14,400 plus interest of $5,200. A total of $19,600 worth of net income will be allocated to the partners in this distribution. There is still a remaining $2,400, $22,000 in net income, $19,600 allocated through salaries and interest. The remainder is just divided equally. Half will go to King, half will go to Lee. Thus, we will allocate the $22,000 of net income, $9,600 to Lee, and $12,400 to King. However, there are times when the amount of net income is not enough to cover the salary and the interest. For example, what if the company had only earned net income of $18,000? Recall that the total salaries and interest were $19,600. We have a deficit. We are $1,600 in net income less than what the partners are owed based on salaries and interest. That means we have a $1,600 deficit that we need to allocate. Thus, we will take the $1,600 deficit and spread it equally amongst the partners. So we will reduce the amount of income that they are being allocated by that $800 each, or $1,600 in total. If we were to look at their capital statement at the end of the year, we can see that the beginning of the year capital balances are increased by any owner investments during the year, plus the amount of net income they were allocated, less any drawings or withdrawals that they took from the business during the year to get to their ending capital balance. The balance sheet we're seeing here, and this is just a partial balance sheet, notice that the owner's equity is the same as for a proprietorship where there's only one owner, except there are more than one capital account in owner's equity. So that's really the only difference. The closing entries for a partnership are very similar as well to a proprietorship. All revenue and expense accounts are first closed to income summary. Then we close income summary to each partner's capital account for his or her share of net income or net loss. And then we close out the partner's drawing account. So the journal entries are the same, we just have two different capital accounts. Here we are seeing a journal entry to close out net income of $32,000 to these two owners. Net income and net loss is shared equally. So of the $32,000 in net income that was closed into income summary in our first closing entry, we will then close out income summary by splitting it 50-50 to the two owners' capital accounts. Same process as with the closing entries for a proprietorship, we just have two capital accounts. Same thing with the drawings. We are going to close out the owner's drawings account in their individual drawings accounts to their individual capital accounts. So again, those journal entries in the closing process are not any different than they were in the proprietorship, except we have multiple owners.